Good evening, everyone, and welcome to our Launch Credit Union Credit Score webinar. We are very happy that you all registered and joined us tonight. We've held many of these credit score webinars in person at our branches, and I'm sure some of you out there may have attended these, but due to COVID, we are hosting these virtually still. But you still get the same great information, but now you just get it in the comfort of and safety of your living room or wherever you may be. Hopefully in the near future, we will be able to host these again in our branches. But for now, for everyone's safety, we are continuing the virtual method. Just a few housekeeping things. Everyone is muted right now, but we do encourage your questions. Please use the chat box feature or the questions box off to the side of your screen to let us know any questions you might have. If you're not familiar with the chat or the questions box, it is a box off to the side where you may see the presenters, and you can just type in your questions, and we will either try to answer them along the way, or we may hold off until the end of the webinar to answer them. On an iPad, it may be the question mark at the top of the screen if you're on an iPad. But a reminder though, please do not include any personal information like your account number or your social security number or anything like that in your chat questions, please, just to be secure. I don't know where you are right now, but it is thundering like crazy. It must be 5 o'clock here in Brevard or Volusia or Orlando, wherever you are. Now our presenters would like to introduce themselves. First, I'll introduce myself. My name is Kelly Haskins. I am the Vice President of Marketing here at Launch. I've been here for about 14 years. I am a proud UCF grad, go Knights, and I have a great team of marketing professionals here at Launch who I work with. Our job is to make sure that our members know what kind of products and services we have that'll help them the most in their lives. Plus, we're always looking for new members, and bottom line, we are here to save our members money. So if you're not a member yet, we do invite you to open your account with us, either at any of our branches or online on our website at launchcu.com. We do have that ability now. You just go to the website and you can open your account right there. Dan Onofrey is going to be doing part of the presentation for you tonight. He is our Vice President of Consumer Lending here at Launch. He has more than 30 years experience in the lending field. He says he was only 9 when he started, so I'm not sure if that's possible, Dan, but we'll give you that, okay? And his goal is, and his team's goal is to help our members achieve their personal financial goals. Sherry Chamberlain is also joining us as a presenter. Sherry is Vice President of Collections, and she has more than 20 years experience in banking and collections. So she shares her wealth of knowledge to help our members like you and in lending, and to help to improve or correct their credit score. So she has a lot of knowledge that she's going to share. We also have a couple of people working behind the scenes to pull off this live presentation for you tonight. That would be Emily Thornburg and Carly Mixon. So they're working our polls and our questions. So if you hear some voices in the background without pictures, that would be Carly and Emily. So now you know who all of our presenters are. Let's get started with our first poll. We want to know, first of all, if you are a Launch Credit Union member. So we'll give you just a few seconds here to select your answer. Make sure to hit the submit button when you're finished. A lot of people forget to hit submit at the end. So just let us know if you're a Launch Credit Union member or not. We'd love to know. Usually we have mostly members, but we'll see. Is the poll over with? Let's see the results. Yep, sure enough, 92% of you are members. A few of you are not members, so we definitely invite you to join us from whatever bank or financial institution that you're at. Come see us. So we do have another poll. We can pull that up. And do you know what your credit score is currently? Just select yes or no. Maybe you don't know what the exact number is, but you have an idea of what it is. You can select the last one. It may have been a while since you applied for a loan to find out what your credit score was. And when you do apply for a loan, by the way, you will find out what your credit score is. And the results are yes, kind of split between yes and just not quite sure. Not the exact number, but you have an idea. That's good. Very good. So, Dan, now would be a great time for you to take over and let our audience know just what a credit score is and a lot more. So, Dan, take it away.
Hey, thanks, Kelly, and thank you everyone for joining tonight. It's great to see everyone. And like Kelly mentioned, yeah, we really want to get back out into the branches, but it's really the best thing for everyone. Let's just stay safe. We can still deliver all this great information to you in the comfort of your home while everybody's staying safe. But don't worry, we'll definitely be out there again. So it'll be some time. But let's get going. Let's dig in. Let's talk about credit. We're going to get a lot of great information today. We're going to get some information about how to either build and possibly or even rebuild your credit. Just get some great information about what credit is. Just a lot of great information that you can take back with you. So let's start out. Like, what is a credit score? What is a credit score even? What is it? I always like to tell everyone it's really your report card. It's something that can prove to lenders how you pay on all your loans. Just, it gives a good idea, a good inkling of how you pay everything. So if you go on to the next slide. We're going to tell you, this is going to tell you how you're going to get a credit score. For all our young members that may be on the call right now that are just starting to build credit, it takes one trade line to establish a credit score. And your trade line has to be open and active for at least 6 months. So what's a trade line? Okay, so a trade line is basically any loan that appears on your credit score, whether it's a credit card or an auto loan, a mortgage, an installment loan, line of credit, any one of those are trade lines. So once you get a trade line, you get it on your credit report, it's open and active for about 6 months, you're going to establish a credit score. Now, first time around, I usually see, the low to mid 600s as a starting point when you're first establishing a credit score. Yes, I've seen it higher before, I've seen it lower before, but when you're first establishing, just kind of count on going in with around that 620 to 640 credit score mark. That's where you're really going to start out with. And then from there, that's when you're going to start building. The next couple of slides that you're going to see here, these are just some good information, good slides that's going to tell you the benefits of what a higher credit score does for you. Like, for example, on this slide here, pretty obvious. I mean, if you have a higher credit score, you're going to have a better chance of getting approved for a mortgage if that's what you're going for. And at the same time, if you do get approved for a mortgage, a better score, for the most part, leads to lower interest rates. Lower interest rates leads to lower payments and savings, and just, it's all about your credit score. You just got to work on your credit score. It can really impact the amount of money that you're paying on these loans. And the next slide, kind of saying the same thing too. Better rates, higher credit score is going to give you better rates. But also think of it this way: you're possibly going to have an easier time of getting approved. And also, it's not just lenders out there that are using your credit scores. There are a lot of employers out there now and over the years that will run your credit. Apartment complexes, if you're trying to apply and get an apartment, a lot of times they're running your credit. Like here on the slide, you're trying to apply for auto insurance and mortgage, homeowners insurance. A higher credit score may, mean lower payments, lower premiums. So it's really important to have a higher credit score. Like, for example, let's say you're going for a job and the employer is undecided. It's you and it's this person, and your credit score is a 600 and the person you're going up against has an 800 credit score. Well, I would hate for the credit score to be the deciding factor, unless it was the opposite way if you had the 850. But that could happen. So it's, like I said, it's very, very important that you build a credit score early on and you work on it and you take a lot of the tips that we're going to give you today to build your credit. So I think the next slide, I think we want to start out with showing you a short little TikTok video. Okay, this is a new video that our marketing department just put together just recently, and this is fresh. You guys are all going to be the first ones to see it. So I think, Emily, go ahead and take it away.
Credit utilization ratio makes up 30% of your credit score, and it's the second most important factor in making up your score.
Let's go over what happens to your credit utilization ratio if you close a line of credit. Let's say you have two $10,000 credit cards and one $30,000 personal line of credit. Both credit cards have $5,000 balances, but your personal line of credit has zero. Your total available credit is $50,000 with a $10,000 balance. To get your credit utilization ratio, you'll want to take your $10,000 balance divided by your available credit, which is $50,000, and your ratio is 20%. You want to keep your ratio at 30 or below. Now, let's take the same example and take away your personal line of credit. Now your available credit is $20,000 with a $10,000 balance, which means your ratio is now 50%.
The lower your credit utilization ratio score, the better. It's better to have a line of credit and not use it than to close it, because this keeps your credit utilization ratio lower.
Chew on that for a minute.
Okay, thank you. Yeah, that was a good video. And I'm going to explain and go into that a little bit more in detail in a minute or so. Those are some good terms, utilization and capacity, some terms that we definitely want to make sure that when you leave today that you understand everything about that. But this next slide, this is our pie chart, and this gives you good information about what really makes up your credit score. Okay, so we really have 5 parts to the pie here. You got payment history, which is approximately 35% of your score. Your revolving capacity, that is approximately 30% of your score. And credit age, new credit, and types of credit make up the other 3 parts. Okay, so the next slide that we're going to talk about, it gives you some information about the first big piece of the pie. 35%, yeah, that's a big part, big piece of the pie. It sounds pretty easy, self-explanatory, but again, maybe not. But again, 35%, just pay your debts on time, you're going to get the most points possible. But what are public records? What are collections? People may not even know that these could impact your score also. So a lot of times your collections and public records could be people suing you for public records. Collections could be maybe medical collections or utility bills or your phone bills that you haven't paid. And if they get to a certain point where you haven't paid them, they'll wind up putting them on your credit report. It stinks because they don't report you when you're current, but if you fall behind for a couple of months to the point where you go into collections, they'll report you on your credit report and it'll have a pretty severe impact on it. So again, payment history, make sure you're paying everything on time, pay your utilities on time, pay all your medical bills on time, try to keep everything current, and you're going to get the most points possible in this piece of the pie puzzle. The next slide that we're going to get into, this kind of talks a little bit about the TikTok video that we just saw. Okay, we're talking about revolving credit cards, your capacity, your utilization. Want to definitely make sure you understand these terms. Okay, so utilization, again, utilization is how much of your credit cards that you've used up. And capacity is how much you still have available. Okay, so let's take some live examples to better explain it. Let's say I have one credit card. Okay, I've had my launch credit card. I've had it open for about 20 years. I've got a $10,000 limit on it, and I got a $5,000 balance. Okay, I've utilized 50% of my credit card, 5,000 of the $10,000 limit. So that's 50% utilization. Capacity, I still have 50% available. So my capacity is 50%. Okay. So if I were to change it around and say, okay, I only have a $2,500 balance on it. Okay, now my utilization is 25% and my capacity is 75%. So it depends on, I'm trying to make it easy numbers here, but again, it depends on what your balance is and how much your availability is. Okay. Now, a good thing to also know that is when you're trying to build your credit score, revolving credit cards is an easy way to gain some points on your credit score. For each percent of capacity that you have, it'll add a point to your credit score. So if we're looking at that last example that I just went over, okay, I have that $10,000 credit card with a $5,000 balance. Let's say I got my tax return, okay, and I paid off that credit card, okay. So now my balance is now zero. What's my utilization? My utilization is zero. I paid it all off. I have nothing utilized. My capacity is now up to 100 because before it was 50. I paid it all off, and my capacity went, like I said, went from 50 to 100. Let's say I had a 600 credit score, and I did this. Okay. I went from a 50 to 100% capacity, so I picked up 50 points. I can expect my credit score to go from 600 to about 650 just by paying off my credit card debt, okay? Now, your credit scores can go up and down every single month depending on how you use your credit cards. So I paid off all my credit card debt, my one credit card that I had, my score went up, and it can take a month or two for it to go up. But then a couple months down the road, my washer and dryer needed to be replaced. And let's just say I had to go out and purchase a new washer and dryer, and I had to spend another $5,000 to do that. I know that's could be an expensive washer and dryer, but just to keep it easy, now I'm back to being 50% utilized with only 50% capacity. I've lost some capacity. My credit score is going to go down. It's going to go down approximately 50 points. So you can see how, like I said, your scores can go up and down every single month depending on how you utilize and use your credit cards. Okay. If you want to have the most points available and most points possible, I know there's a lot of, things out there where they say, oh, try to only keep 20 or 30%. That's how you get the best score. If you really want to have the best score possible, don't carry any credit card debt. Okay. You want to make sure they never go inactive. So, every once in a while, use your credit card, pay it off. But to get the most points possible, keep your credit card balances at zero. Okay. The next slide that we're going to go into, it's the third piece of the puzzle, third piece of the pie. And this talks about credit age. And again, it has to do with your credit cards. So let's use examples. I always like to use good examples when I'm explaining how this works. So let's say I have my one launch credit card. Again, I've had it open for 20 years, okay? And that's the only credit card I have. My credit age is 20 years old. I have one credit card, it's open for 20 years. My age is 20. So I go and I open up a few credit cards. Let's say I open up 3, okay? Now I have one credit card that's been around for 20 years, and I have 3 brand new credit cards that are 0. They're brand spanking new. So now instead of my age of credit being 20 years, now I have that 20 years with the one, but now I have 3 brand new ones. I have to divide by 4. Now my credit age went from 20 all the way down to 5. Okay, That's a big hit. Now 5 is still pretty solid, but 20 is an excellent credit age. That's where you're really striving for. And again, time is what builds credit. Okay. So I think we have a video coming up, but I think maybe we'll stop for a second, maybe take a question. Yeah, let's take a question from the audience. And
we actually have a few questions.
good.
Yeah, one is a line of credit a trade line?
Yes, a line of credit can be trade lines. So you can have different types of lines of credit. You can just have a regular note line of credit where it's just like an unsecured loan, but it's open. So you can borrow, pay it off, and then keep borrowing, and it stays open like a credit card. You also will hear the terminology called a HELOC, which is a home equity line of credit. And that, again, that's a line of credit, but it's using your house's collateral. But again, both of these examples will show up on your credit report as trade lines.
Okay, and then I have, why do auto insurance companies care about your credit worthiness?
Well, they care about your creditworthiness because they also want to be paid back too. So there's risk involved with that. And there's also risks where they're seeing that someone with a lower credit score maybe is a potential for an accident. I'm not sure, but it definitely has to do with both of them as far as your probability of paying them on time and also the probability of possibly having an accident. So that which could affect which could affect the amount of premiums that you would pay.
Okay, great. And I've got one more. Is it smart to close credit cards, and will it keep my credit score, or will it help my credit score if I close them?
Okay. That's a good one. Good question as far as credit cards, and it's good because we're on this topic also. It's not the same answer for everyone. I guess if I'm going to answer that, I'm going to say it depends. So I guess closing credit cards, let me give you a couple examples, okay? I have 2 credit cards in my wallet, okay? They both have $5,000 limits on it. So 2 credit cards, you add them up together, I have $10,000 in limits, okay? And on one of those credit cards, I have a $5,000 balance, right? If I were to close one of those credit cards, okay? Now, instead of having $10,000 in limits, I have $5,000 in limits. What does that do? Okay, it just affected my capacity, my utilization. Okay, before I closed that credit card, I had 2 credit cards with a $10,000 limit, $5,000 balance. My capacity was 50%. When I closed that one credit card, now I have a $5,000 limits and $5,000 balances. That's not good. Now it's showing that I'm fully utilized, 100% utilized. A lot of times you hear the word maxed out on your credit cards. That's what would happen if you did that in this scenario, okay? Your capacity would go from 50% all the way down to 0. You have no capacity because you just closed out the one card that had capacity. So in that scenario, I wouldn't close your card, okay? Here's another scenario. Let's go back to the other example, or one example where let's say I have one credit card, I've had it open for about 20 years like before, and I opened up 3 new credit cards, okay? Now, let's say I paid off all those credit cards, I got those credit cards for the holidays and I paid off the balances. So I have no balances anymore, okay? Then maybe it's okay to close 1 or 2 of those credit cards, okay? Which one am I gonna close? Well, I'm definitely not gonna close the one that's been open for 20 years. What I may look at doing is maybe closing one of the ones that I just opened up for the holidays, okay? What's it gonna do? Is it gonna impact my capacity? No, because like I said, I paid off all my credit card debt, so I have 0 balance. I may not have as much limit, but again, I have no balance, so my capacity is still 100%. And if I closed out one of the new credit cards that I just took out, now it's helping me with my age of credit again. So I'm going to pick up some points in that piece of the pie. So again, as far as making a decision on whether to close credit cards out or not, it's not a yes or no for everyone. And if you're ever unsure, oh, by all means, just come in, talk to us, sit down with one of our MSRs, our member service representatives at the branch. They can talk to you about it, and then we can see if it's the right thing to do for you. Okay, do we have anything else, or is that the last part of the questions?
We may save some to the end because I think they might be answered in the rest of the presentation.
Yeah, okay. All right, so next slide. It looks like we have another short little video for you, give you some good information. So. Okay, I think I'm back. Okay. Another great video, great information here. So let's go to the next slide. I think this, okay, so these are the last two pieces of the pie that makes up your credit score. These are the smaller pieces here, new credit and types of credit. New credit, let me explain that a little bit. And what this really means is, when you're out there and you're adding on new trade lines, it has an impact on your credit score. And for example, every time you have somebody run your credit, it's a 5-point hit on your credit score. So you can expect your credit score to go down about 5 points. And every time you add a new trade line, you're going to add on, you're going to subtract, you're going to lose probably about 10 points on your credit score. So think of this. Let's say you have about a 700 credit score, okay? And it's the holidays, you go out shopping, you go to Macy's, you go to Kohl's, you go to wherever, J.C. Penney's, and you get to the register and you get up there and you're about to pay with cash or your debit card, and they say, hey, would you like to save 10%? You know, take out a credit card, we'll see if you can get 10% off your purchase. Great. You do that, you get 10% off, you save a couple of bucks, you do that at all three, okay? Now think of the impact that has, okay? So you just apply for 3 credit cards and you got approved for all 3 credit cards, okay? You lost 15 points with 3 inquiries, and you're gonna lose probably around 30 points for 3 brand new trade lines going on your credit report. That's about 45 points. And then, if instead of using the cash that you're almost ready to make pay for your merchandise with, you use the credit cards that they just gave you, now that's going to have effect on your capacity and your utilization. So, you know, opening up just a couple of small little credit cards during holidays, you know, it depends. Now, if you're financially fit and you have sound credit, you know, you're in the upper 700s, 800s, yeah, it's okay to go ahead and open up a couple of credit cards. But, you know, if you're in that part of time where you're trying to build credit, or let's say you have a vehicle and you need to maybe purchase a vehicle in the next 6 to 9 months. Now's not the time to start opening up credit. Now is when you want to just continue to build on what you have, pay down on your debt so your scores go up. So be very careful. That's how new credit can impact your credit score. And types of credit, this is another small piece, and what the credit scoring models like to see is how you pay on different types of loans. And that will give you more points on your credit score. So the more different types of loans, like if you have mortgages and auto loans and different credit cards, all different types, and you're paying well on them, that'll give you a little bit more boost on your credit score also. Okay, next slide. Now, these next couple of slides, what this does is it gives you some information about what some of these life events could impact on your score. For example, again, if you file bankruptcy, or if you have to, or if you can't make your payments on your mortgage and you go into foreclosure and you lose your home, yeah, these are some pretty heavy points that you're going to lose on your score. Short sales, you could lose up to 80 points. An automobile repossession, 100 points. These are very, very impactful. And the next slide, I think it just reiterates again what I spoke about a little bit ago. Again, every time you apply for credit and somebody runs your credit, you can expect to lose up to 5 points. Now, with inquiries, they only impact your credit for approximately a year. They'll stay on your credit report for about 2 years, but again, it only impacts for a year. And the kind of way it also works is it's gonna impact you 5 points right in the beginning, but as you slowly get closer and closer to the year, like when you get 9 or 10 months in, that inquiry may only be a point or two. But then again, after a year, it'll fall off altogether as far as impacting. New trade lines, like I spoke about, again, that's 10 points. Instant bounce back. On the last screen, there was another thing that if you were, say, delinquency 30 days late, it could impact your score by up to 60 points. So go back to the next slide again. Instant bounce back. What that means is, as long as you take that loan and bring it current like the following month, you're going to get a majority of the points back. So if you lost about 60 points and you bring it current right away, you're going to get about 45, 50 points back, probably the next month or two. And then it'll take a couple of years for you to get the remaining points back. And again, at the bottom, that last bullet point, that's our formula again for capacity. Again, please, you want to make sure you understand that. Very important. 1 point on your FICO score for each % of capacity. Okay. Next slide. Okay. So this is one of the slides I love. Okay. This is what I call the 40-30-20-10 rule. And what this is really telling you is that, yes, the credit bureaus, they understand that you can have things happen in life. You have life events. Nobody wakes up every day. Nobody wakes up and just says, you know what, I don't feel like paying my bills anymore. It happens because things happen in life, whether it's people getting sick or you lose your job or people get divorced. Things happen. And when these things happen, it causes many times for a bankruptcy or a foreclosure to happen, and your score gets affected because of this. But what this model is telling you is, after a year goes by, 40% of the impact that event had on your credit score goes away, okay? And then another year, 30% goes, and then another year, 20%. So you can see after 3 years, 90% of the impact that those events had on your credit score goes away. And then you get the remaining 10% in the next couple of years. So there's always light at the end of the tunnel. And trust me, I've helped and worked with members many a times over the years that have filed bankruptcy. They've come in, they've worked with me. You're able to get your score back up to a 700 within 18 to 24 months. You just got to do it the right way. Okay. So here, I think what I'm going to do is turn it over to Sherry. She's going to take over the second part of the presentation and take you home before we get into our final questions. Go ahead, Sherry.
Good evening, everyone. Thanks for joining us. My name is Sherry Chamberlain. I'm the Vice President of Collections here at Launch. I also have extensive background in lending, as well as with banks and credit unions. Dan has provided us an abundance of information. As you can tell, basically it's a juggling act. You have to balance many things. The amount of credit you have available, the amount you use, but the biggest, most important factor is how you repay those loans. Any credit union, financial institution, or bank is in the credit risk business. And how you pay your bills is how you're judged on your rate. Now, as Dan said, everybody has hiccups. This is the part of the webinar that's going to tell you how to improve your credit score and rebuild your credit. Everyone has hiccups. Life events, like Dan had mentioned, have happened to pretty much everyone. We want to show you how to pay less, and that is taking the time to clean up your credit report, know your credit report. We'll get into it a little bit later and give you the website and the numbers to contact to get your free annual credit report. And I would recommend that everyone do that. It is free. They do not give you a score, but it gives you a chance to look at everything that's on there and how it's being reported. So if you want a lower rate, it definitely pays to keep an eye on your credit. How to improve your score and rebuild your credit. Number one, always pay your bills on time. This is the juggling act that Dan had mentioned as well, is keeping the capacity around 30 to 35% of being utilized. And this is very important. Don't borrow more than you need, and keep a buffer of credit available to you. As Dan had mentioned, and this recently happened to myself, the washer and dryer goes. Well, they're not as cheap as they used to be. So you can easily go into a store, put it on a credit card without impacting or having to open up perhaps new credit. You can use credit that you already have existing. All right, next slide. Very important. Do not close older credit cards. This is very important for the longevity part of the score. If you have credit cards that have been open for a long time, keep them open, keep them, keep them active, which is also important. Now, one of the ways it has been brought up to lower payments is to remove the revolving debt, which may involve credit cards at much higher interest rate, move that to an installment debt to where you pay monthly installments for a set period of time, most of the time at a set rate. Don't open a lot of new accounts. As Dan had mentioned, you go in the stores at Christmas time, hey, we're running a promotion, 20% off if you do this today. Be very, very careful about opening cards because it'll impact when they pull your credit. It affects the longevity of the accounts. And ask yourself, do I need this credit? Am I going to use this credit? If you're just opening it up for the 10% off for that day only, it's something to consider. You may not want to open that card at this time. All right, next slide. All right, do we have any questions at this time?
We do. We have, what's the best way to get out of credit card debt?
Credit card debt. I think that gets everybody at some point. There are quite a few options that you would have at your disposal. You can move credit card debt to an installment loan. You can go to your local financial institution. It's a product we offer here at Launch, and that would be a debt consolidation or personal loan to where you take that credit card debt at a high interest and put it in a fixed monthly payment for a certain period of time. Most of the time, you're going to have a lower rate. You're going to be able to budget monthly a lot better. And you have the debt consolidation loan, HELOC, or any line of credit would also be an option. Most of those carry a very reasonable rate with attractive repayment terms. And then a HELOC would also be basically tied to your home, because that is a home equity line of credit. Another option, which a lot of borrowers have used, especially in the last year with mortgage rates being as low as they are, is to refinance their primary residence with cash out, pay off that credit card debt, and then just roll it into a 30-year mortgage. That is a very popular method. Now you have two other theories that people use. They use similar ones. One would be a snowball. And what they mean by snowball is taking all your debt, starting with the small balances, and then making the minimum payment on all your credit cards. But then as the smaller balances get paid off, roll that money into the next credit card and the next until you eventually get up to the higher debt. The avalanche method uses slightly different principles. That one takes your high interest credit cards, paying off the high interest first, and then going downhill so that you're paying off the lower interest cards last and the more expensive cards or debt first. Both are effective in what they do. You know, you can always run a scenario and figure out which is best for you. Those are some options that are out there. Once again, you can always come to launch. We can look at your situation and see what options are available to you. Any more questions?
Yes, we have, what's the difference between the TransUnion, Experian, Equifax, and FICO credit scores?
Actually, the three big ones, which are going to be Experian, Equifax, and TransUnion. Those use their own models, very similar to the percentages that Dan laid out. Now, FICO is going to use basically information collected from those particular bureaus to come up with a score. And that was originally known as the Fair Isaac. Now, Launch does use a FICO score.
Okay, and then if you increase your credit line on a credit card, does it affect your score?
Yes, yes, because your capacity just went up. So there's a good chance it will impact. A lot of times what you have, I had, let me use this as an example. A lady, her credit score recently dropped 70 points. She closed her credit card. She had opened up a debt consolidation loan. So what you have there is multiple things going on at the same time. You know, the credit card had longevity. She wound up closing it. We got a new trade line with the installment loan. But yes, it would impact your score.
Yeah, absolutely. Because think about it. If you're raising your credit limits, you're giving yourself more capacity. So go back to the formula. The more capacity you have for each percent of capacity, you're going to pick up a point in your FICO score. So yeah, that's a great way to increase your credit score. You can go out to, if you have a couple of credit cards that you have balances on, you can go out there and see if they'll increase your limits by a little bit. That's a great way to raise your credit score also. Absolutely.
Any more questions at this time?
We had a few more come in, but we can save them to the end. That's okay.
All right, and I think it's time for our next poll. Have you ever had to dispute an error on your credit report? Yes or no? Now, when it comes to answering disputes on credit reports, we're going to get into it shortly on the methodology behind that, and as well as who normally handles that. Collections department in most organizations will handle a dispute and do an investigation and provide a resolution or an answer or a response within a certain amount of time. All right, wow, so it's almost 50-50, so that's pretty interesting. That's pretty interesting that 50% has had to dispute stuff on their report. Okay. How do you dispute an error on the credit report? Very simple. Go to Experian.com or Equifax.com. It's very easy to do online. Now you also have the option, and especially here at launch, we will handle direct disputes. So if you go into the branch, you see an error on your report that has to do with a launch account, bring it to someone's attention and they will send it to the proper personnel to investigate thoroughly and respond to you, generally within 30 days. Sometimes we may come back and ask for more information. When it comes to a dispute, what we're looking for is exact and specific information that you're disputing. I get a lot of times they give me their name and they say, you reported me late. I kind of need to know, hey, you reported me late in June. I wasn't late in June. I made my payment on time. Here's a copy of the copy of the check or the payment that I made. So specifics are extremely important. Next slide. Should I go through a credit repair company? The bottom line answer to that one is no. We receive some correspondence from credit repair companies. The bottom line is they cannot do anything for you that you cannot do for yourself. And then as a credit furnisher, which launches any bank, any financial institution is, we cannot report things that are not true. And it's the same goes if you say, oh, I normally make my payment on time, but I just missed it this month. Well, there's really not much we can do about that since it wasn't an error on the credit union's part, that it truly was a missed or late payment, even though it was perhaps only a day or two. So therefore, it is extremely important to make those payments on time. A payment does not hit your credit report as late until it's 30 days or more. So remember that if you're able to make that payment at 20, 22 days, you will save yourself a lot of points and a lot of headaches. I've had a lot of people in the last year that were going to buy homes. Mortgages are quite strict about having a late payment within the last 12 or 24 months. And if it truly was a late payment, there's nothing I can do to remove that payment. It's on the consumer at that point to really make those payments on time. It really will pay off. Next slide. What is your Credit Karma? Why is your Credit Karma score different? Credit Karma actually uses the Vantage score, and believe it or not, Credit Karma is owned by all 3 credit bureaus. And we use FICO, which is the industry standard. And a Credit Karma score will be using a slightly different formula. It'll get you in the ballpark of where your score is if you were to go to a car dealership and they gave you, what your actual score is. It'll be somewhat similar, but they do use a slightly different formula. And Credit Karma is used by consumers, and FICO would be used by lenders or financial institutions to make a credit decision, which is what Launch currently uses. How much can you save? This chart is a great example of $20,000 financed for 6 years with various credit scores. You are looking at, if you're at a 550 or below, really an $88,000, almost $9,000 more that you'll pay in interest over those same 5 years versus someone with a 730, even a 680. Their rate's 395, your rate's going to be 17.95. So there is a huge difference in the amount you're going to pay and repay, which affects how much free cash you've got each month to spend on other items. And it is important to maintain, good payment histories, a relationship with these financial institutions, and you'll wind up paying a lot lower rate. Next slide. Here are some big things to keep an eye on if you're ever asked to co-sign on a loan. If you're co-signing on a loan, you're co-borrowing on the loan. You are responsible for that loan. You're responsible for the repayment of that loan. You know, a financial institution such as ourselves, we will be seeking repayment from either the borrower or the co-borrower or the co-signer, you know, to repay that loan. If the other party winds up in any financial situations, we will look for repayment from the co-signer as well. And legally, they would be held responsible should anything happen to the loan and the loan goes in default. Authorized user. Authorized user can be good and it can be detrimental to the authorized user. Now, the authorized user, it will show up on their credit report. They are not financially responsible for repaying that debt, but it will show up on their credit. Now, also, the authorized user has the ability to use the account, because they're mostly credit cards, and, you know, utilize that available credit as if they were also just the primary borrower on that card. So it can work for you and it can work against you. But also, you know, be cautious of that. If you're allowing someone to be an authorized user on your account, or if you are an authorized user on someone else's account, proceed with caution, like it says. Here's the information we had discussed earlier about obtaining your free credit report. Everybody is entitled to one free copy of the credit report every 12 months. Now, unfortunately, it doesn't give you your true accurate score, but it'll allow you to look through it line by line and see what actually is being reported to your credit, and allows you to fix it at that point. And we explained earlier how to repair your credit with either Equifax or any of the other major bureaus, or you can actually go to the credit issuer yourself and generally write them a letter, an explanation of what you're inquiring about, be as specific as possible, you know, provide any supporting documentation, and they will respond to you generally within 30 days. There's also an 800 number here that you can call. You will need to provide some information, but I would use these specific websites and phone numbers, because if you're off, as you know, you can find yourself on a fake website real quick. But this information is readily available. And I think, is that the last of our slides? Yeah, anytime, you know, go into some of our branches, we certainly would welcome the opportunity to sit down and go over any credit report or any questions that anyone may have. You can also visit our website. There are plenty of information and resources that are available there. Do we have more questions?
We do. How does refinancing a home or vehicle affect a credit score?
You want me to take that one?
You can. I'll jump in also. Go ahead.
Okay. But, you know, anytime you have an event when you're refinancing, if you're paying off one mortgage and taking out another one, you know, this one you might be paying off for $150,000, but now you're taking out a new mortgage. So you're going to have multiple events going on at the same time. You may increase your capacity by increasing the amount of the new mortgage, or you may be keeping it the same, but you also could be paying off a mortgage that you've had for 10 or 15 years. So you've got a solid 10, 15 year history. So a lot of times these are multiple events happening at the same time. You're going to see the initial drop anytime you have an inquiry and also have that new credit, and you may have lost some with a mortgage you've been paying on for 10 or 15 years. Eventually, you're going to get that bounce back. Like Dan had said, a lot of times you're going to take. Generally, anytime I've redone my mortgage, the score will drop for the first couple of months, but you're going to see it climb back up. You might see a 20-point drop for the first 60, 90 days, and then you're going to start to see it crawl back. More questions?
Any other questions?
A lot of the other questions were related to mortgages. So I did ask them to reach out to us afterwards so that we could get their questions over to the mortgage department.
Okay.
Sure. The one thing I wanted to add on the car insurance, somebody had asked why car insurance inquires. You know, they're in the risk business too. And if you've got somebody with a solid pay history, generally they're a lower credit risk and a lower risk overall. But also when you are purchasing a vehicle, you need to think about the cost of insurance as well. Sometimes it's not the vehicle, but it's also the insurance. So that's something to think about as well. Just thought I'd add that.
And also, we gave you a lot of information on those last couple of slides about getting free credit reports every year. Use your Credit Karma app. You know, I have it, I use it. I don't depend on the score, just so you know. What I'll use Credit Karma for is for trends, okay? If I look at my Credit Card app and I get my score this month and my score says this, and next month it's the same, and the month after it's the same, but then all of a sudden 1 month it drops 60, 70 points. Like, what happened? Oh, was I late? Did somebody was there fraud? I mean, that's how I use Credit Karma. I use it to see, you know, just to monitor, see if my score changes, you know, something where it normally shouldn't change. And then I investigate. Because you can see all your trade lines, everything on your Credit Karma app. It gives you a lot of good information. But again, don't, like Sherry was mentioning, the score, it's a different model than we use. So if you're going to use Credit Karma, just use it for the information and the trend of how your credit score is changing from month to month, just to make sure that there's nothing funky going on.
We actually just had another one come in. It says I'm currently a co-buyer or co-buyer and want to refinance to get the original buyer off. Being that their credit score is higher than mine, would the interest rate go up if I'm approved?
Yeah, it's possibility it could go up. And you got to remember also when you originally were approved for that loan with the cosigner or joint applicant or however it was structured, you know, you had both incomes there qualifying you, and you had both credits. And if they were the higher score, yeah, if you're now able to get approved on your own and your score is lower, you may though pay a higher interest rate. Lenders for these type of products, what they're usually using, I know we do here at Launch. If we have 2 people on a loan, we'll use the higher of the 2 scores. So if you're taking off the higher credit score applicant, yeah, you're probably going to have a higher interest rate. Any other ones? Or
The other ones we might have to reach out to after.
okay.
Thank you.
Okay.
All right.
Well, I
Kelly?
think we're going to wrap it up, guys. That was really good. And I can tell you, I've sat through a lot of these and I learned something new every single time, every time. So yeah, you guys always bring, you know, a little bit more, little bit different items and tips. So I definitely learn every day. So thank you for taking the time to join us, everyone. We will be hosting additional webinars in the future. I think we have a mortgage seminar coming up next month. So be sure to check our calendar on our website at launchcu.com. Also be sure to follow us on Facebook, Instagram, LinkedIn, and we are now on TikTok also. And you guys got a sneak peek preview of one of our latest TikTok videos. They're all educational. They're very entertaining, but they're also educational. So we encourage you to follow us on all of the social media platforms. You will be receiving a follow-up email from us with a link to this recorded webinar. Please feel free to reach out to any of our lenders for any questions you may have concerning lending questions or credit score questions. There is a survey also at the end. So please hang around, take the survey, take a moment and share your feedback with us. We do read everything and we learn a lot from it. So everyone, please stay safe and stay well and stay dry. It looks like the rain stopped. And thank you Have a great rest of your evening.
Thanks for coming out, everyone.
Thank you.
Bye.